Hello, this is Bob Call. It's Friday, August 14th, 2015. I just wanted to provide some information about the markets. And so first of all, I thought I'd talk about the CAPE ratio. That stands for cyclically adjusted PE ratio. And if you look at my website, sabinoim.com, under resources, research articles, you can find these several articles. The one I'm referring to is this one here, CAPE Predicting Stock Market Returns. And in this article, they show the connection between the CAPE ratio and real returns for the following 15 years in this study. So the blue dots are all equity markets. Then they have Japan, and the red dots, Germany, yellow, and the USA from 1979 through 2013 in black. And so the CAPE ratio is not a good predictor on an annual basis, but if you look at long-term returns, they tend to, the standard deviation narrows around this regression line here. And so in the United States right now, the CAPE ratio is 27 times the cyclically adjusted earnings. And that would indicate that the expected return in the US would be about 2%. And it says real return, so that's after inflation, compounded annually for the following 15 years. And a website that, this is a very good website here, Research Affiliates. So they publish their real 10-year expected risk and return information. So they have the different asset classes, and here they show the US large cap stocks and US small cap stocks. So the standard, what they call volatility here is one standard deviation. So on an annual basis, that means in a given year they would expect 65% of the returns to fall within the range of plus or minus 15%. But their expected return here is based upon the yield of 2%, 1.3% growth, but they're expecting a valuation change of negative 2.4% on an annual basis. And so so when they add those up, it's 0.88% for the S&P 500. US small cap stocks are more expensive than large cap stocks. In the past, the valuations for small cap and large cap stocks have been pretty close, but right now the PE ratios are higher on US small cap stocks. One study I saw indicated that in the Russell 2000, about 20% of the companies had negative earnings. So for the Russell 2000, the yield is lower, 1.4%, a little bit higher growth at 2.0%, but they expect the valuations to come down over time, so they're showing negative 3.5%. For a total expected return of negative 0.2%, and again, that's after inflation, or real return. So and so if we look at the other asset categories, you can, in some cases get a similar return. Over here, this is a global core fixed income. And so that return is over 1%, but with lower volatility. And so at this point in the portfolios, I'm recommending that clients have half to 1/3 of their normal equity allocation. This website also has more detailed information. This is the overview. If we click on equities, they have it by country. So the U.S., because their CAPE ratio is higher than the other countries, has a lower expected return. In many of these other countries, we see higher expected returns, but also a pretty high level of volatility compared to those expected returns. And this just shows some of the major countries. So U.S., for the U.S., the Shiller PE ratio is now 27 times earnings. In Australia, it's about 16. Japan is 28, about the same as the U.S. The UK is about 12. And so they're showing an expected return in the UK of 5.1. Brazil, the Shiller PE is at 9. That's fairly low. And they're showing an expected return of 9%. And Russia has the lowest Shiller PE of all at 5 times earnings. And so they're showing an expected return of 12.8%. That's compounded annually over the next 10 years. Volatility for that is pretty high at 38%. Okay, and let's go to, thought I'd talk about the U.S. economy a little bit. See if I can get that. So this is the Federal Reserve Bank of Atlanta. They have a forecasting model called GDP Now. They use some of the most current data available, and that's why they tend to lead the forecasts of many of the other economists in the country. So if you look at this, the blue chip consensus forecast right now has come down a little bit lately. But that's currently at 2.75% for the third quarter of 2015. The Atlanta Fed GDP Now forecast is currently at about 0.7%. So it's been lower by about 2%. And what we've seen in the past is that the blue chip consensus tends to come down towards the Atlanta Fed's GDP forecast. We're also seeing some information consistent with that lower forecast. This is an article. Information was prepared by an analyst called, his name is Nick Colas at ConvergeX. And in these tables here, he shows the expected year-over-year revenue growth. And this is for the Dow Jones Industrial Average, 30, large cap companies. But what we saw in the second quarter, and there are a couple of companies that have not reported yet, I believe, but the revenue comparisons are negative 3.5% compared to a year ago. And for some of the multinational companies, some of that may be due to foreign exchange changes. So if they have significant operations overseas and they're earning money in foreign currencies, once that's translated back to dollars because the dollar's been going up, that would lower their revenue. When you exclude financial companies, that's the second portion on the right here, it's negative 3.6%. So on the expected year-over-year revenue growth, and this is based upon analyst coverage of many of the analysts that cover these companies. For the third quarter of 2015, where they're currently forecasting negative revenue growth of -4%, and excluding the financial companies, minus 4.4%. And then they expect some recovery in fourth quarter 2015, negative revenue growth still of, but it's a lower amount, negative 1.8%. So the trend here over the different months, starting in March, April, May, June, July, August, has been, consistently lower expectations for revenue. And then here they show first quarter 2016, so they're expecting revenue growth compared to the prior year of 1.9% and 1.8% excluding financials. Some of the holdings that we have are what we call closed-end funds, which are, I only buy the ones trading at a discount to net asset value. We recently had one Transamerica Investment Income shares, which announced that they would be merging, the management would like to merge it into a mutual fund company. So when we bought it, it was trading at a 10% discount. As a result of that announcement, it's now trading at a 2% discount. And assuming shareholders approve it, and usually shareholders do approve these resolutions when they're, endorsed by management, this should go to net asset value sometime by the end of December. So for now, I'm still holding on to it. We have some other closed-end funds which are trading at pretty good discounts. The Aberdeen Asia Pacific Income Fund is now trading at a 17% discount. So the dollar has been strong lately, so the discount has widened a little bit on that. And one of the holdings that I bought for taxable accounts, for many of the taxable accounts, is the Nuveen Pennsylvania Investment Quality Municipal Fund. So it's a single state tax-exempt closed-end fund. It's currently trading at a discount of 14.4%, and they do use some leverage. They're borrowing money at anywhere between 90 basis points to 1% or 100 basis points. That short-term money, it resets on a weekly basis, and so they're borrowing. They're using that money to buy longer-term tax-exempt securities and capture the spread. So that's one of the ways they're able to increase the yield. They're also, another reason the yield is pretty good is because of the discount to net asset value. So we're paying 86 cents on the dollar at the present time. And so the distribution rate is 6.24% at the present time. And the duration for that is currently about 10 years. So, and that duration is adjusted for leverage. So when I look at these leverage funds, when I look at duration, I always look for the duration that's adjusted for that leverage. Let's see. Another holding that's selling at a pretty good discount is Tricontinental. So this has a 4-star rating from Morningstar. The expense ratio is pretty low here. It's let me see what that is. It's currently 0.49%. sells at a discount of 15.1%. This fund has very little leverage. It's only 2%, and the distribution rate is 3.8%. And if we look at the holdings for this, it's they'll have a lot of names that you recognize. There's Apple, Cisco Systems, JP Morgan, Microsoft, Johnson & Johnson, Pfizer, Philip Morris, International Paper, Comcast, Intel, Citigroup, Merck, MasterCard. So we're able to buy these companies through this closed-end fund at a discount of 15% at the present time. And this discount has been pretty steady. If we look at the monthly premium and discount history, it's been pretty constant at 14 or 15% over the last 5 years. So this is a fund that's been around since 1929, so I don't expect them to open-end the fund or merge it with one of their mutual funds. If I look at the 10-year history, there were times when it started trading, right here back in 2008, or excuse me, that was February 2009. It actually traded right at about net asset value. And then we see divergence, so the net asset value has gone up faster than the market price. But I think a 15% discount is a pretty big discount on a fund like this. It has a low operating expense ratio and performance that has been pretty good. So yeah, I would expect over time I would expect that discount to narrow. And this is a website called tradingeconomics.com, and one thing I wanted to just show on this is a great website if you want to look up economic information by country. So if we this is their overview that has a list of a lot of major countries, and one of the columns is their government budget deficit. So most of the countries have budget deficits at this point, and then they show debt to GDP. So if we click on the United States, for example, debt to GDP has risen quite a bit since 2008. It was at 64.8% in 2008. Now it's a little over 100%. And that's kind of been the case for a lot of countries. If you look at the, well, let's just look at Italy, for example. So their debt to GDP in 2008 was 103%. Now it's 132%. Or Japan, it's now at 230%. 2008 it was at about 167%. So, I think governments and central banks responded very actively to the problems of the last financial crisis, but they increased their debt to GDP ratios quite a bit, during the last 7 or 8 years. So now I think governments have less flexibility to deal with any future crisis because now their debt levels are very high. Something else that I often look at is the current account. deficit. So we've actually seen some improvement in terms of percentage of GDP for the United States. So back in 2007, the current account was running at about 6% of GDP. Now it's about 2.4% of GDP. But the U.S. has a big economy, so in absolute terms, that's still a pretty big number. And so here we can see the 10-year number. And so when the United States runs a negative current account balance, that has been offset by foreign capital coming to this country. And if we look at external debt for the United States, I'm just going to widen this out to 10 years. So this is a cumulative number. We're currently at about $6.8 trillion. So that means foreign investors have $6.8 trillion more invested in the U.S. than U.S. Individuals and corporations have invested overseas. So and one of the people that's written about the capital flow situation is Chris Hamilton. So he has a blog, and in this blog he talks about central bank currency swaps. So when we look at this, okay, this is a good table or graph here. It shows the change in foreign held U.S. Treasury debt by China, Russia, and OPEC. So in 2002 to 2008, China bought quite a bit of U.S. Treasuries, 415 billion. That actually increased in 2008 to July 2011 to 822 billion over that time period. And Russia was also buying U.S. Treasury debt, as well as OPEC, the OPEC countries. And then we get to July 2011 through February 15. Now we see actually a reduction in U.S. Treasury debt held by China and Russia as well. OPEC still had a positive addition to their U.S. Treasury debt, but it's at a lower rate than what we've seen in the past. And now, because of the lower oil prices, the oil exporting countries are not generating the revenue to be able to continue buying U.S. Treasury debt. So so we've seen the natural buyers of U.S. Treasury debt go away. China was a big buyer, and Chris Hamilton thinks July 2011 was a turning point because at the time there was an argument in Congress going on about whether or not they should raise the debt ceiling for Treasury debt, and that just put a spotlight on the United States debt situation. So China expressed some concerns at the time, as well as Russia, and so Chris Hamilton thinks, well, that's why they decided they were going to reduce their U.S. Treasury debt holdings in after July 2011. So who's buying U.S. Treasury debt now to to make up for the natural buyers not being in the market anymore when the U.S. is running a trade deficit? So here he shows the total U.S. Treasury holdings for he shows the core EU countries: Germany, France, Italy, Spain, Netherlands. So these are the larger economies of Europe. but we don't, that's the red line here, but we don't see very much increase, from January 2002 through February 2015. Where we see the larger increase is from some of the, calls them the ECB countries, or for European Central Bank. And so these are relatively small countries. When they show up on the TIC, that's the Treasury capital flow reports that come out on a monthly basis. So we see purchases from the countries of Belgium, Luxembourg, Ireland. And when I looked at these countries, they do have a trade surplus, but together it amounts to about $7 billion per month, and the U.S. is running a trade deficit of about $42 billion per month. So they're buying a lot more than any surplus they're generating from international trade. So the question is, how much longer can they keep that up? The Federal Reserve has swap lines with these countries to exchange, to lend currency, lend US dollars to these other countries. And so he's got a graph here with the Fed swap line partner nations, Treasury purchases by period. So we saw a ramp up by the ECB countries and also the Bank of Japan. Bank of Japan is, they used to be running a large trade deficit. That's no longer the case. So this is the Japan current account to GDP. So in recent years, it's come down quite a bit, and the reason for that is they have been outsourcing their manufacturing to other countries that have lower wages, very much like the United States has done. Whoops, I want that. See on, I'll talk about precious metals a little bit. This is an article about the derivatives, the commodity derivatives exposure of JP Morgan, and the so there was, this is by quarter. These are from reports on file with the Office of the Comptroller of the Currency. So we saw a big increase in the first quarter of 2015, and then Citigroup, it was the same type of situation, big increase in the first quarter of 2015. Now, these reports don't say if they're on the buy or the sell side, or exactly, how much of it is gold or silver. So we don't really have the details, but we know both of those large banks increased their exposure to precious metals derivatives quite a bit in the first quarter. There's also another article. So we've seen pretty strong demand for gold and silver coins at the US Mint, the Canadian Mint, and also the Perth Mint in Australia. This is a graph showing the U.S. Mint ounces of gold sold. So there's a big increase in July when the price came down. And here, this graph here shows the, let's try to get a bit bigger image of that, shows COMEX registered gold. So back in 2006, there were over 5 million ounces of gold in the registered category at COMEX. The registered category is available for delivery on the open contracts. Now we're currently down to 351,000. So it went from over 5 million now down to 351,000 at the COMEX. And if we look at the ratio of, let me see. Sorry about these pop-ups. When we look at the ratio of open interest to registered gold, it's at a historical high now. So if you go back to 2000 through, say, about 2007, this ratio was about 10 to 1. So that means there were 10 ounces of open interest for every ounce of registered gold at the COMEX. Then it started going up in 2009 to, and starting in about, the latter part of 2009 to 2013, the average was around 20 times open interest to registered gold. Then we saw a big spike. It came back down, and now we see another big spike. So now we have a record amount of open interest to every ounce of registered gold at the COMEX. So this, increases the probability that there would be a delivery failure at the COMEX. So if you ever, buying a futures contract on the COMEX is not a good way to buy gold, because there's a very high probability you wouldn't be able to take delivery of the gold even if you wanted to. So the question is, how is this all going to get sorted out? Kyle Bass had a conversation years ago, several years ago. He's on the committee, the investment committee of the large Texas trust fund that provides an endowment for the universities and schools in Texas. And they bought $1 billion worth of gold on the COMEX. They took delivery and stored that in a warehouse. But he had a conversation at the time with the head of the COMEX, and at the time I think the ratio of all futures contracts and options for gold were about 30 to every ounce of registered gold they had at the COMEX at the time. And the the response of the head of the COMEX was, well, price can fix that problem. Meaning, if the price goes high enough, people that own futures contracts would take profits, sell their contracts, reducing the open interest to some point where they're actually able to deliver gold. So, though, I think that's about it for the update at this time. And if you have any questions, please contact me, and thank you for your time.